Welcome to the Holistic Wealth and Health Podcast. Your co-hosts, Jason Smith and Brian Bibbo, will inspire and teach you how to prosper in your mind, body, and spirit, not just your financial life. Joining forces with field experts, Jason and Brian are here to help you focus on what matters most in your life, living well.
Hello, and welcome to another episode of the Holistic Wealth and Health Podcast. I am your host today, Matt Seitz, CMO here at Prosperity. And today, a special guest, Jeff Warnkin. Thanks for joining us today, Jeff.
Thanks for having me, Matt. Happy to be here.
Yeah, Jeff, a returning guest for us, Jeff Warnkin. For those that haven't met Jeff with us before, Jeff Warnkin is a senior wealth manager at Prosperity Capital Advisors and a 25-year veteran of the financial services industry as a certified public accountant, certified financial planner, and national Social Security advisor. He specializes in estate, financial, and retirement income planning, helping families navigate life's biggest financial challenges. So today we got a little different topic. Today we're going to be talking about RMDs, legacy, and what you might be missing. So, Jeff, why don't we jump right in for that? So,
let's go for it.
People may know RMDs are required, but they don't always understand why they exist or why the timing matters. So, what should retirees really understand about how RMDs work?
Well, the required minimum distribution rules are really about mandated or forced withdrawals from your IRAs and 401ks. You don't have to spend the money, but you do have to remove it from the funds, from your tax-deferred accounts, and pay the tax. Remember, IRAs and 401ks are funded with pre-tax dollars, funds for which you received a tax deduction on the way in. They've grown tax-deferred over the years. But at some point, the U.S. Treasury says, okay, we let you grow these accounts long enough. Now it's time we'd like to start collecting some of those tax dollars. And required minimum distributions begin in the year you turn 73 or age 75 if you were born in 1960 or later. The calculation's rather complex, but suffice to say they're calculated each year off the balance of your retirement accounts divided by a factor from the IRS life expectancy tables. So it can be, as I said, quite complex.
Yeah. What do you think are the most common mistakes that you see clients making around the RMDs, and what does it end up costing them?
I could spend all day answering that question, Matt. It's a great question. As you requested, let's stick to the most common mistakes. So as I alluded to before, just calculating the required distributions properly is a challenge, and it's a mistake that we see all the time. The rules are complex, and some types of accounts like IRAs and 403Bs can be aggregated for purposes of the calculation, and others like your 401ks cannot. They have to be calculated and satisfied separately. So miscalculating your required minimum distribution can cost you a penalty of 25% of the amount you miss it by. So it's something you have to take seriously and make sure that you do it correctly. Next up, I think the next most common thing is assuming that your custodian, like Fidelity or Charles Schwab, or the like, are going to police this for you. That's a misconception. You'll likely, once you're of the age where you're subject to required distributions, you will likely receive a letter from your custodian indicating that you are subject to the requirement, and they will offer a calculation for you. It's not necessarily the right number for you, so you need to be very careful. It may be correct for that particular account, but they don't know if you have other accounts at other custodians. So you need to make sure that everything is aggregated properly, and you can't just rely on the custodian to calculate that for you. Those are the practical nuts and bolts mistakes that we see. and that can be very costly. But honestly, not having a proactive plan to deal with required distributions it is huge. It's never too early to begin planning for these distributions. For example, if we see 5 to 7 years out that a client will not need their RMDs to cover living expenses, we may recommend converting a portion of their IRA to a Roth beforehand, because Roth IRAs are not subject to required distributions during the account owner's lifetime. Or we may recommend beginning qualified charitable distributions at age 70 and a half to reduce the balance subject to RMDs later. But not having a proactive game plan can mean that the IRS becomes a bigger beneficiary of your IRA over your lifetime than even your family. And so it's very important that you have a game plan to address these required distributions. Lastly, I would say that because required minimum distributions are mandated withdrawals from your retirement accounts each calendar year, you're forced to sell to cover these withdrawals, even if it's not a good time in the market. Not having a portion of your funds to cover these withdrawals in a more conservative account that will be not subject to the full volatility of the market is another big mistake that we see. As you know, at Prosperity Capital Advisors, we subscribe to a bucket plan approach for segmenting our clients' investable assets, utilizing the now, soon, and later bucket. Well, we typically recommend several years worth of required distributions in the soon bucket, invested more conservatively in case there's a major market correction, just as you start to be subject to these mandatory withdrawals.
No, that's very helpful information, Jeff. And like you said, you're just covering the most common, mistakes. There's probably several others, and the most important part is being proactive. And so, if you're tuning in, you're watching, you're listening, make sure you're being proactive. You want to speak to Jeff, speak to a qualified advisor, book with one of our team members. You can click the link in whatever platform you're watching on to make sure you speak with one of our team members, but make sure you're doing the due diligence on your end to make sure you're not costing yourself for any of these mistakes that Jeff might have covered today. So, Jeff, how do the required minimum distributions affect the rest of a client's financial picture? So their tax bracket, their Social Security income, even their Medicare premiums.
So a great question, because required distributions are withdrawals from your retirement accounts and are taxed as ordinary income, which are potentially the highest rates in the tax code. These withdrawals can bump you into a higher tax bracket. Also, the additional income you recognize because of these withdrawals can mean that more of your Social Security benefits will be subject to tax. This multiplier effect is called the Social Security torpedo because it blows up your tax return and nobody sees it coming. Finally, there's the potential for increased Medicare Part B and D premiums. These premiums are means tested, which means that your Medicare premiums can double or even triple based on the amount of income you're reporting. This is called IRMA, the income-related Medicare adjustment amount. So required minimum distributions can cause your Medicare premiums to increase through no fault of your own.
Got it. So that's what I was going to ask you about that. So that's what happens when we have like clients or attendees at our workshops asking about that when they see that the large RMD increases their Medicare. That's how that happens.
Yeah, exactly. Because the income that we report this year is going to determine our Medicare premiums 2 years from now. There's a 2-year lag. So in the first year that they're subject to required distributions, and they take that income out, it hits their tax return, and they think nothing of it other than having to pay on that extra income. And then 2 years later, they get their letter from the Social Security Administration saying what their benefits are going to be for that year and what their Medicare premiums are. And a lot of times they're in for a big surprise there. Now, it only elevates the premium 1 year at a time. It'll reset. But since RMDs, once they kick in, you have to do them every year. You can get into this loop where every year your Medicare premiums are getting increased because of that IRMA.
Got it. Okay. So then when it comes to leaving money to your family, to your loved ones, how do RMDs factor in, and what do most people not think about until it's too late?
Yeah, well, what we see, Matt, is that the very clients who have accumulated sizable balances in their retirement accounts and typically lived within their means and have done well in other non-retirement savings. So ironically, they quite often don't need the required minimum distributions to supplement their other income in retirement. And in these cases, the retirement accounts really become legacy assets to be inherited by the adult children or grandchildren. And what most people don't focus on is that their beneficiaries will have to pay the tax on the entire account balance within 10 years of inheriting the account. And they'll have to claim that income on their own tax return, subjecting it to their marginal tax rate. So with proper planning, these negative effects can be potentially minimized. There's a lot to that 10-year rule. In some cases, the beneficiaries will be subject to required distributions during those 10 years. And then they have to, but either way, the account has to be emptied out by December 31st of the 10th year. And all that income is going to hit their beneficiary's tax return. So with proper planning, we can minimize or help them avoid that situation.
Got it. Then so the beneficiary designations, they come up a lot in legacy planning. Why do you say that document can carry more weight than a person's will?
A great question. And I think that is because assets that pass by beneficiary designation, so retirement accounts, IRAs, annuities, even life insurance, just to name a few, they actually bypass probate and therefore bypass your will. Your will might say everything goes to your 3 children. But if your beneficiary designation says differently, that's how the funds will be distributed regardless of the provisions in your will. So it's a good idea to do a beneficiary audit, beneficiary designation audit every few years and make sure that you have the right primary beneficiaries and also contingent beneficiaries. And especially important if you have family formation changes and things of that nature, just to make sure that the right accounts are going to the right people, because it doesn't matter what your will says. If it's an account that's driven by beneficiary designation, that's who's going to get the money.
That makes sense. So then there's going to be ways to manage RMDs more intentionally, like things like Roth conversions or giving directly to charity from your IRA. Who do those strategies make the most sense for?
I'll address qualified charitable distributions first.
Okay.
So these are going to be most applicable for clients who are already charitably inclined and are maybe giving annually already to a charity that they care about, that's very near and dear to their heart. But they're giving that out of their current income, out of their current savings. And once they turn 70 and a half, and they actually have to be 70 and a half, it's not the year they turn 70 and a half, they have to hit their 70 and a half birthday. Yeah. Those contributions, if it comes directly out of their IRA to the charity, they don't pay any tax on it. So it's a great way that you can satisfy your required minimum distribution, either in part or in some cases in whole. There are limits to the qualified charitable distributions. It's a little over 100,000 is the limit per person. But it's, that's a pretty nice, pretty large limit. And so in many cases, you can satisfy that required distribution, again, in part or in whole, and not have to pay any income tax on the withdrawal. And that's especially important because that means that there's no Social Security torpedo that we talked about before.
Yeah.
and no income-related Medicare adjustment amount, IRMA. Neither of those concepts would apply to qualified charitable distributions. Roth conversions would be next up as another great tool to control required minimum distributions. So this strategy is going to be most attractive if you do not need immediately your required minimum distribution to supplement your income. So if it's okay for you to defer that income to a later date, or if you don't need it at all, and it becomes a legacy asset like I talked about before, that's where it's going to be most powerful. The strategy involves converting a portion of your IRA to a Roth IRA each year. So it's best if we start well in advance of the required beginning year to spread the tax hit out over several years. We call this bracket bumping. So that's the practice of converting enough each year to take you to the top of your marginal bracket. So for example, if you're in the middle of the 12% bracket, we might take you up to the top of the 12% bracket, or even the 22 or 24% bracket, depending on your circumstances. So one of the reasons that Roth conversions are so powerful is that there's no required distribution during the lifetime for the owner of the Roth IRA. So you're never forced to withdraw these funds if you don't need them. You can keep your retirement account intact and fully invested for as long as possible. And if you don't end up needing the funds, when the beneficiaries inherit the balance in your Roth IRA, they can keep the funds invested another 10 years before they have to empty the account out. Now, even at that point, when they take the money out from underneath the umbrella of the Roth IRA, there's no federal or state income tax on a penny of it. It's all completely tax-free. So Roth conversions can create a really powerful legacy strategy, like we talked about earlier.
So very, very powerful stuff there. So no, thank you. Thanks for sharing that, Jeff. So how about if someone listening today is already taking RMDs, what's the one conversation they should be having with their advisor that most people aren't having?
I think it really goes back to having that plan. It's never too late to put a plan in place. And there's a lot of misconceptions about the Roth conversions, for example. A lot of people are under the misconception that there's an income limit or a dollar limit as to how much you convert and that sort of thing, or you can't convert after you're subject to required minimum distributions. And that's not true. Once you are subject to required minimum distributions, you do have to satisfy that requirement for the year. But then after that, after you've satisfied that, after you've taken that money out and paid the tax on it, you can still do Roth conversions. And in some cases, in many cases, it still makes sense to do that even after required minimum distributions have begun. So my message, I think, to the listeners would be that it's never too late to get a plan. It's never too late to start a plan. It's, as we like to say, everyone has a tax plan, whether they think they do or not. And if you don't have your own proactive tax plan authored by you and your financial advisor, then you're on the default plan, which is authored by the U.S. Treasury. And I would venture to guess that the default plan is designed to benefit the government more than it is to benefit you and your beneficiaries.
No, I like it. Words of wisdom. Thank you. Thank you, Jeff.
My pleasure. I know it's not the most exciting topic in the world, but it's really important because these required minimum distribution rules have been in practice, in place as long as I've been in practice, 3+ decades. And as I said, you can't assume that your custodian is going to police this for you. So it's really important that you have a plan to address these. And it can make a huge difference in the amount of expendable income that you receive versus what your family receives. We have the old saying that your money can only go one of three places: your family, charity, or IRS. And we have control over that split if we do that proactive planning.
No, I very much appreciate that. I think that this is, whether you are already taking RMDs or are obviously approaching that time, I think that there's a lot of nuggets in this information that can be saving you a lot. And like you said, being proactive with it, planning ahead is what helps you avoid these pitfalls. So, if you are already with us, please feel free to reach out to Jeff or anyone from our team. If you are not already, please check out the contact information in the notes or on our website. Jeff, thank you very much again.
My pleasure. Thanks for having me, Matt.
Yes, and thank you all for tuning in again today for the Holistic Wealth and Health Podcast. Enjoy the rest of your day.
Thank you for listening to the Holistic Wealth and Health Podcast. We hope we inspired you to make changes so you can live your best life. If you want to find out more about what we do, or if you want to have a holistic wealth and health financial plan, please call 456-833-7000. Please subscribe to the podcast and share it widely with your friends and family. Financial planning and advisory services are offered through Prosperity Capital Advisors, PCA, an SEC-registered investment advisor with its principal place of business in the state of Ohio. J.L. Smith Holistic Wealth Management and PCA are separate, non-affiliated entities. PCA does not provide tax or legal advice. Insurance and tax services offered through J.L. Smith Holistic Wealth Management are not affiliated with PCA. Information received from this podcast should not be viewed as individual investment advice. Product discussions and illustrations are hypothetical in nature and will vary based on many factors, including, but not limited to, age, health, product, insurance carrier, and product design. You should consult the insurance carrier website and policy for detailed information. For information pertaining to the registration status of PCA, please contact the firm or refer to the investment advisor public disclosure website, www.advisorinfo.sec.gov. For additional information about PCA, including fees and services, send for our disclosure statement as set forth on Form ADV from PCA using the contact information herein. Please read the disclosure statement carefully before you invest or send money.